There's one number in your business right now that tells you exactly how underpriced you are. Most owners look at it every month and think it's good news. It's not. If your sales team is closing 60, 70, or 80% of the people they talk to, that feels like a win. A high close rate, strong team, great offer, right? Wrong. A close rate above 30% to 40% usually means you're leaving 2 to 3 times your current revenue on the table. That number isn't telling you your sales team is great. It's telling you the market would pay dramatically more and you're simply not asking. The insight that close rate is a pricing signal comes from Alex Hormozy. We took that and built it into a full diagnosis system because knowing you're underpriced doesn't tell you what to fix first, how it cascades across your profit and loss, or what to do about it. Here's what I'll show you why close rate is a pricing signal and not a performance metric. The exact bands that tell you how much to raise, how to calculate it correctly so you're not working with bad data, and the one situation where a high close rate does not mean you should raise prices. That last one's important. Skip it and you might overshoot. 70%. If you're closing 70% of the people who get on a sales call with you, most business owners would celebrate. The sales team is dialed. The offer is strong, don't touch anything. But here's what's actually happening. 7 out of 10 people hear your price and say yes. That means your price is so low that almost nobody says no. The market is telling you loudly that they expected to pay more, that the value you're delivering is worth significantly more than what you're charging. Think about it from the buyer's side. If someone offered you a $100,000 service and you were mentally prepared to pay $250,000, you say yes immediately. You don't negotiate, you don't shop around, you close fast. That's what a 70% close rate looks like from the other side of the table. A healthy close rate is, for a high ticket B2B service business, is 30 to 40%. That's the range where you're priced right. Some people say yes, some people say no. And the ones who say yes value what you do enough to pay for it. Above 50%, the math starts saying something different. So if your close rate tells you you're underpriced, the next question is, well, by how much? That's where the bands come in. How much should you actually raise? This isn't a guessing game. There are specific bands tied to specific close rates. Close 80% or higher, triple to quadruple your price. If you're closing more than 8 out of 10 calls, you are dramatically underpriced. Not a little, 3 to 4 times underpriced. This is the most common band I see in businesses under 3 million, and it's one owners have the hardest time believing. 60 to 80%, you should be doubling to tripling your price. Still significantly underpriced, most businesses in this band have been charging the same rates for 2 or more years while their value has compounded. The market moved, their pricing didn't. 50 to 60% raised by about 50 to 100%. It's a moderately underpriced, a meaningful increase, but not a complete overhaul. 40 to 50, it's about a 25 to 50% raise, and you're slightly underpriced. Fine tune this area. If you're at 30 to 40%, your pricing is probably right. If your close rate is in this range and your gross margin is still below 60%, the problem isn't pricing. It's a delivery efficiency problem. You're spending too much to deliver the work. That's a different fix. Those bands are aggressive, and I know the first objection. What if my close rate is high for a different reason? And that's the right question to ask, and there's a way to confirm it. Here's what I don't want you to do. See a 65% close rate, triple your prices tomorrow morning, and blow up your pipeline. The bands are a default recommendation, and they're right the vast majority of time. But before you commit to a full increase, you need to confirm that the high close rate is a pricing signal and not something else. And we don't make snap decisions that aggressive. We need to do this slowly over time. A high close rate can also be driven by 3 things that have nothing to do with price. We could have exceptional lead quality. If you're only talking to perfect fit prospects who are always going to buy, like a tight ICP, a strong referral network, or a qualification process that filters hard, your close rate is high because of who you're talking to, not what you're charging. The tests are unqualified leads also closing at a high rate. If random inbound leads are closing at 60%, it's pricing. If only your filtered, hand-picked prospects close that high, it might be lead quality. We want to average it out over time, depending on on your split. Low competition niche. If buyers don't have realistic alternatives, they'll close at almost any price. The test: would a competitor charge 2 to 3 times for a similar scope? If yes, it's pricing. If competitors don't exist in your niche, be more careful with the bands. I still think we should raise our prices slowly over time, but we should start looking at our margins and then just slowly bump it up depending upon lead flow. Because a lot of those people that don't have competition, we don't have a good marketing funnel at that point, because a lot of the time it's so new that we can go out there and have conversations with people and they'll just convert. And then unusually skilled sales team. It's rare, but it does exist. The test: are new salespeople closing at the same rate? If your close rate stays high even when a junior rep runs the call, it's pricing. Here's the practical step. If you confirmed it's likely pricing, test with the next 20 calls. Don't overhaul your entire pricing structure overnight. Raise it for the next 20 prospects. Monitor the close rate response and let the data confirm. If close rate drops into the 30 to 40% range, you found the right price. If it barely moves, continue to walk it upwards. So you know what close rate means, you know what band you're in, and you know how to confirm it. There's one more thing: how to make sure the number you're using is actually right. Most business owners think that they know their close rate. Most of them are calculating it wrong. Here's the right formula. Close rate equals new customers divided by booked sales calls. Not inquiries, not proposals sent, not leads generated, not qualified booked calls. Booked sales calls as a total, meaning calls that actually happened where a human talked to another human about working together. Use a 12-month rolling average would be for the best to calculate what the into the future looks like, but you should be tracking this every single month. If you aren't, go back as far as you can. Don't calculate this month to month. It gets very, very noisy. Especially one month you'll have really good leads, the next you'll have a few, depending on your ads. There's a lot of different variables. One great week or one bad week will not distort everything, but an 8 to 12 window smooths the data and gives you a number that you can actually act upon. We want a minimum sample size. We want 20 calls. Again, 12 months is always great, but go back as far as you can without going insane, because if you've only had 10 sales calls in the last quarter, you don't have enough data. 70% close rate on 10 calls could be noise. A 70% close rate on 40 to 50 calls, that's a signal. And here are the two mistakes that wreck data most often. Mistake one: counting inquiries instead of book calls. If 100 people filled out a form, 40 booked a call, and you closed 20, the close rate is 50%, not 20%. The form fill to booking conversion is a marketing metric. Close rate is a pricing metric. Don't mix them, keep them separate. Mistake number two: don't raise aggressively enough. Your close rate is 75%, you raise the price 20%, close rate drops to 68%. You think it worked, it didn't. You're still in the 60 to 80% band. The bands say double to triple. A 20% increase should have gone 2 to 3 times, means you left the majority of the pricing gap on the table. Now, again, I like to do things fairly aggressively because the quicker we make the moves, the quicker that we're able to actually see where we land. However, a lot of the times with business owners, in reality, is that they're not going to make a 200 to 300% jump overnight. Okay, that's understandable. We traditionally work with the business owner dependent upon their level of fear, and then we raise it 20%, 20%, 20%, and we walk it in just like sight in a gun. If this is changing how you think about your pricing, subscribe. Next video, I'm walking through a real company that applied these bands. 2.5x price increase, revenue went up, it didn't go down. Your close rate is a pricing signal. Above 50%, you're underpriced. The band tells you by how much. The qualifier tells you to confirm before you commit. And the rolling average on 20 to 40 calls tells you if the data is clean. Now, in the next video, I'm going to show you a real company that was closing 65%. They raised their price by 2.5x. The close rate dropped to 38%. Revenue grew to 40%, and gross margin jumped 13 points. And I'll show you what went wrong along the way, because it's not always smooth. Link is in the description if you want us to run this diagnosis on your numbers. We only do about 15 spots a month. Let us know if you need help.